All right, today on Talk Tickers, we are diving into an earnings report that was an absolute monster. We're talking about Workiva's second quarter for fiscal 2025, a report that didn't just impress the market, it completely blew expectations out of the water.
And when I say blew them out of the water, I mean it. The stock surged over 32% in a single day. You just don't see that happen very often. This wasn't just a good quarter. It was a statement that forced Wall Street to completely reevaluate the entire company.
So how does a stock rocket up like that? Well, it's pretty much always the result of one thing, the classic beat and raise. Workiva didn't just post great results. They told the market that things are going to get even better.
Okay, let's get into the nitty-gritty. These are the headline numbers that lit the fuse. Analysts were looking for revenue around $209 million. Workiva came in hot at over $215 million, a solid beat. But the real jaw-dropper was on the bottom line. The street was modeling 5 cents a share in adjusted earnings. Workiva delivered 19 cents. That's not just a beat. That's nearly 4 times what anyone was expecting. Just incredible.
You know, beating the estimates is great, but what really matters to serious investors is the quality of that beat. So let's pop the hood and see what's really going on with the health of the business.
And yeah, the quality was definitely there. Take a look at this. Their growth engine, that high-margin, recurring subscription revenue, was up a massive 23% year over year. At the same time, the lower-margin professional services side of the house was flat. That is exactly what you want to see. This shift is what's fueling their whole profit story.
Now, for any software as a service company, this next number is absolutely crucial. Net retention rate. Workiva posted 114%. So what does that mean? It means if you take their entire customer base from a year ago, those same customers are now spending 14% more. It's the best sign that your product is sticky and that you're successfully selling more solutions to your existing clients.
And of course, you can't have great net retention if customers are leaving out the back door. Which brings us to this, 97% gross retention. That is, frankly, a best-in-class number. Hardly anyone is leaving their platform, which creates this incredibly stable fortress of a customer base to build on.
So they're keeping their customers and they're selling more to them, but they're also landing much bigger fish. Just look at the growth here with their large contracts. The number of clients paying over $500,000 a year grew by 35%. This proves their platform is resonating with the biggest companies in the world.
The CEO, Julie Izzard, really drove this point home on the call. In today's market, the whole growth at any cost playbook is dead. So hearing this message of disciplined, profitable growth backed up by expanding margins, that was music to investors' ears.
So, the numbers are strong, for sure, but the commentary from management tells us how they're pulling it off. Let's dig into the strategy behind the numbers. Management pointed to a couple of key drivers. First, big companies are starting to standardize on Workiva's platform for a whole bunch of different things. They even gave an example of a Fortune 500 bank signing a 7-figure deal to use them for reporting, governance, and sustainability. The other big piece of the puzzle is their partners, especially the Big Four accounting firms. These guys are basically bringing Workiva huge deals on a silver platter, giving them incredible reach.
Okay, the results we just talked about were fantastic, but they're backward-looking. What really lit a fire under the stock and caused that massive jump was the company's outlook for the future.
This right here is the rocket fuel. Look at the guidance for full-year adjusted earnings. The consensus on Wall Street was for about $1.04 a share. Workiva came out and raised that to a range centered around $1.35. That's a massive 30% lift to the earnings outlook. It signals incredible confidence from management.
They also covered a few other important items. They announced that their longtime CFO is stepping down, but it seems very well managed. They were also super transparent, calling out that demand for sustainability solutions has softened a bit. But, and this is key, they said that slowdown is already baked into their new, stronger guidance. And finally, they're not assuming any recovery in things like IPOs, which means if that market comes back, it's all potential upside.
So where does all this leave investors? The market has obviously reacted in a big way, but what does the path forward actually look like for Workiva?
After a 32% jump, the obvious question is, what's the trade now? Is all the good news already baked into the price, or is this really the start of a whole new chapter for the company?
Okay, so here's our take. Our core thesis is built on 3 pillars. First, this platform is becoming absolutely mission-critical for complex reporting, and they're showing clear signs of improving profitability as they grow. Second, there are some clear catalysts ahead. We're watching their new AI features, their continued push into large enterprises, and a smooth CFO transition. So, when you tie all that together, it leads us to our rating. We are initiating our coverage with an outperform rating, the combination of fantastic execution, a guidance that we think still has room for upside, and powerful momentum for the platform just justifies a premium valuation. We really believe this quarter marked an inflection point in the company's profitable growth story.
And as always, this analysis is for informational purposes only and is not financial advice.